Before investing in any crypto coin, you must understand what cryptocurrency actually is. Cryptocurrency is a digital form of money that operates on blockchain technology. Blockchain is a decentralized system that records transactions across many computers. This decentralization makes cryptocurrencies resistant to control by a single authority. The first and most well-known cryptocurrency is Bitcoin. Many other coins, called altcoins, were created after Bitcoin. Each crypto coin usually serves a specific purpose or use case. Some coins are designed for payments, while others support smart contracts. Smart contracts are self-executing programs stored on the blockchain. Understanding the purpose of a coin is the first step in analysis. You should always read the project's white paper before investing. A white paper explains the coin's goals, technology, and roadmap. The roadmap shows future plans and development stages. A strong project usually has a clear and realistic roadmap. You should also identify the problem the coin is trying to solve. If there is no real problem, the coin may have no long-term value. Look at whether the project is actually innovative or just copying others. Innovation is often a key driver of long-term crypto success. You should also check if the idea is practical in real-world use. Many crypto projects fail because they lack real-world adoption. Understanding demand is critical in evaluating any coin. If nobody needs the coin, its price may not hold value. You should also learn the basics of supply and demand in crypto. Limited supply can sometimes increase value if demand rises. However, supply alone does not guarantee success. Always consider the bigger market context of the coin. Crypto markets are highly volatile and change quickly. Volatility means prices can rise or fall sharply in short time. Beginners should be aware of risk before investing. Never invest money you cannot afford to lose. Emotional decisions often lead to poor investment outcomes. Research should always come before financial commitment. Good investors rely on data, not hype. Social media hype can sometimes mislead beginners. Always verify information from official sources. Be cautious of fake news and misleading promotions. A strong foundation of knowledge improves decision making. Crypto investing is not gambling when done with research, but without research, it can become extremely risky. Understanding the basics helps reduce unnecessary losses. You should also understand blockchain security principles. Security is essential in protecting digital assets. Hacks and scams are common in crypto space. Awareness of risks helps you stay safe. Education is your first defense in crypto investing. Many successful investors spend time learning before investing. Patience is more valuable than rushing into trades. A strong foundation leads to better long-term results. Never invest based only on trends or emotions. Always build your understanding step by step. Crypto is a long-term learning journey. The more you learn, the better your decisions become. Fundamentals always matter more than short-term hype. Smart investing starts with strong basic knowledge, and this foundation prepares you for deeper coin analysis. The white paper is the most important document of any crypto project. It explains the technical and economic structure of the coin. You should read it carefully before investing. A well-written white paper is clear and easy to understand. Confusing or vague white papers are a warning sign. Check if the project clearly defines its goals. Goals should be realistic and not exaggerated. Overpromising is a common issue in weak projects. You should evaluate the problem statement in the white paper. The problem should be real and meaningful. Next, check the proposed solution of the project. The solution should logically solve the stated problem. Technical details should be explained properly. You do not need to be a developer to understand basics. However, clarity is essential for trust. Look at how the token is used within the ecosystem. Utility increases long-term value of a coin. If the token has no use, it may lack demand. Check the tokenomics section carefully. Tokenomics explains supply, distribution, and incentives. A fair distribution model is very important. If too many tokens are held by insiders, risk increases. Early investor allocation should also be considered. Large early unlocks can create selling pressure. Vesting schedules help reduce sudden dumps. You should always check vesting timelines. Roadmap milestones should be realistic and measurable. Avoid projects with unclear development plans. Look for transparency and documentation. Transparency builds investor confidence. Check if the project has updated its white paper recently. Outdated white papers may signal inactivity. Compare white paper claims with actual progress. Sometimes projects fail to deliver promised features. Look for technical innovation in the design. Innovation often attracts developers and investors. Check if the project uses existing or new technology. New technology should still be practical. You should also understand consensus mechanisms used. Proof of work and proof of stake are common models. Each consensus model has strengths and weaknesses. Security and scalability depend on design choices. The white paper should explain these clearly. If not, it reduces project credibility. You should also check for partnerships mentioned. Real partnerships add legitimacy. Fake partnerships are sometimes used for hype. Always verify partnerships independently. Good projects are transparent about limitations. No project is perfect or risk-free. Honest communication is a strong positive sign. White paper analysis is essential for due diligence. It helps you avoid low-quality projects. It improves your investment decision-making. A strong white paper often reflects a strong project. The development team is a key factor in crypto success. A strong team increases the chances of project success. You should research the founders of the project. Check their experience in blockchain or technology. Experienced developers are more reliable. Anonymous teams can be riskier investments. However, some successful projects started anonymously. Still, transparency is generally safer. Look at LinkedIn or public profiles of team members. Verify their past work and achievements. A good track record adds credibility. Check if the team has delivered past projects successfully. Development activity is another important factor. Active GitHub repositories indicate ongoing work. Inactive development may signal project decline. You should review code updates regularly. Frequent updates show strong progress. Community support is also very important. A strong community increases adoption chances. Check social media platforms for engagement levels. Real engagement is more important than follower count. Fake followers are common in crypto marketing. Look for meaningful discussions in communities. Telegram and Discord are popular crypto communities. Active discussions indicate healthy interest. Developers often interact with the community. This shows transparency and trust. Community feedback helps improve the project. You should also check how issues are handled. Fast responses show strong support systems. Roadmap updates should be communicated clearly. Lack of updates is a warning sign. Marketing should not be the only focus. Real development matters more than hype. Check if advisors are credible experts. Advisors can add strategic value. However, fake advisors are sometimes listed. Always verify advisor involvement. Partnerships with known companies can help, but they must be real and active partnerships. Community trust is built over time. Sudden hype spikes can be dangerous. Organic growth is usually more sustainable. You should monitor sentiment carefully. Negative sentiment can signal problems. Positive sentiment does not guarantee success. Balance is important in evaluation. Team dedication is a strong success indicator. Projects with inactive teams often fail. Consistency is key in development. Always prioritize strong teams in analysis. Community and team go hand in hand. Both influence long-term performance. Weak teams often lead to weak projects. Strong teams increase confidence in investment. If a coin's held by just 10 wallets, you're not investing. You're gambling on whales. I've watched enough rug pulls to know the warning signs. Market cap tells you stability, but volume tells you if anyone actually cares. Low volume means you might buy in easy, but good luck getting out when things turn. Check the exchange listings too. Major platforms don't list garbage usually. Token burns sound great until you realize inflation's eating faster than they're burning. Strong metrics don't guarantee wins, but weak ones almost guarantee losses. Risk management is the final and most important step in crypto investing. You should always define your risk level before investing. Never invest more than you can afford to lose. Crypto markets are highly unpredictable. Diversification reduces overall risk exposure. Spread investments across multiple assets. Avoid putting all money into one coin. Always set clear investment goals. Decide whether you are investing short-term or long-term. Short-term trading requires more attention. Long-term holding requires patience. You should always have an exit strategy. Know when to take profit. Know when to cut losses. Emotional control is very important. Fear and greed often lead to mistakes. Stick to your research instead of emotions. Avoid FOMO, fear of missing out. Many investors lose money due to FOMO. Always verify information before acting. Use multiple sources for research. Do not rely on influencers alone. Influencers may have hidden motives. Always cross-check market data. Security is essential in crypto investing. Use secure wallets for storing assets. Hardware wallets provide better protection. Avoid keeping large funds on exchanges. Be aware of phishing scams. Never share private keys. Private keys give full access to funds. Regularly update your security practices. Learn basic technical analysis if needed. Charts can help identify trends. However, analysis is not always perfect. Combine technical and fundamental analysis. Stay updated with crypto news. Regulations can change quickly. Market cycles influence investment timing. Bull and bear markets require different strategies. Patience is key in long-term success. Consistent learning improves results. Review your investments regularly. Adjust strategy when needed. Avoid panic selling during dips. Market corrections are normal. Strong projects recover over time. Weak projects often fail completely. Final decisions should be based on full analysis. Combine all factors before investing. Never skip research steps. Smart investing is systematic. Discipline is more important than luck. Knowledge reduces investment risk. Careful analysis leads to better crypto investment decisions.